The live intraday price for BigBear AI under the ticker symbol BBAI is currently sitting at $4.04 per share, marking a solid 2.3% gain in the midday session. While most retail investors glance at this $4 ticker and see a highly speculative micro-cap technology play riding the coattails of larger enterprises, institutional accumulators are quietly tracking a completely different metric. The real signal here is not the nominal share price fluctuation, but a sudden acceleration in their defense and national security backlog, which recently grew by over $60 million in high-level government contracts. This structural backlog expansion indicates that the company is quietly digging a defensive moat within the federal ecosystem, shifting from a speculative software concept into a deeply integrated defense contractor. The standard retail perspective on this asset is straightforward and predictable. Most self-investing individuals using common investing sites look at this company as a lottery ticket, assuming it will automatically surge whenever an industry giant like Nvidia stock or Tesla stock prints a blockbuster quarterly report. The general expectation is that this company needs to secure massive commercial enterprise software agreements to justify its valuation and prove it can scale like a traditional Silicon Valley entity. However, looking at the structural reality of their operational model reveals that trying to judge them by traditional software-as-a-service metrics is a fundamental miscalculation. The corporate footprint is not designed to provide mass-market consumer applications or generalized corporate productivity suites. Instead, they have spent decades quietly embedding themselves into the highly restrictive, heavily cleared architecture of the United States Department of Defense and the broader intelligence community. When you track recent daily swings and immediate macro-driven trading volumes, a clear divergence between the general tech sector momentum and this specific equity becomes obvious. Retail volume on standard platforms like the Robinhood app or through basic online investing channels often spikes on pure social media sentiment, causing temporary intraday volatility that lacks institutional support. But when you look at the deeper clearing data from sophisticated nodes like the Interactive Brokers platform, a pattern of quiet, algorithmic accumulation appears during periods of broader market consolidation. Institutional investors using advanced tools to optimize execution fees and account allocations are recognizing that federal defense spending is decoupled from commercial economic cycles. While rising interest rates or corporate budget cuts might pressure commercial software providers, national security allocations remain sticky and structured around long-term appropriations. This fundamental insulation against standard macroeconomic pressures is why the underlying trading activity shows a steady tightening of the float, even when short-term retail traders panic and rotate out of small-cap tech. To put this structural setup in context, consider how the broader market handles asset allocation today. If you look at automated wealth tools like Schwab Intelligent Portfolios or generic robo-advisors, these small-cap specialized contractors are rarely prioritized because their volatility metrics do not fit neatly into traditional algorithmic frameworks. Similarly, conventional asset managers utilizing traditional online investment platforms often bucket this asset under highly speculative technology baskets, ignoring the defense infrastructure characteristics that anchor its revenue stream. When an investor manages an individual brokerage account at a traditional firm like Fidelity, they are typically looking for large-cap stability through standard Fidelity ETFs or broad market Fidelity mutual funds. It takes a specialized hands-on self-investing approach to dig into the actual contract structures and realize that this company functions more like a specialized defense asset wrapped in an artificial intelligence label. To understand why this distinction matters so much for the current equity valuation, look closely at their recent quarterly earnings reports and the immediate operational milestones. The company recently confirmed its full-year revenue guidance while showing a marked improvement in gross margin profile, driven primarily by a shift toward higher-margin software solutions over pure consulting services. This margin expansion is a critical turning point for institutional analysts who have historically discounted the stock due to its heavy reliance on professional services. When a business can prove it can scale its software deployment across existing federal networks without a linear increase in headcount, the long-term cash generation potential changes dramatically. This shift is exactly what sophisticated traders look for when filtering small-cap equities on specialized investing sites or tracking large institutional blocks moving through institutional brokerage pipelines. Comment below how many shares of BigBear AI you currently hold in your portfolio right now. Looking back at the historical foundation of the enterprise provides vital context for its current trajectory. Founded originally in 1988 and headquartered out of McLean, Virginia, the business operated for decades as a deeply specialized mission support partner for federal agencies long before the current tech cycle became a mainstream obsession. They built their reputation by providing advanced analytics, data engineering, and specialized cybersecurity services to the Department of Defense, the Defense Intelligence Agency, and various homeland security frameworks. Their business model revolves around complex, high-consequence environments where decision speed and data conflation are matters of national security. Instead of trying to build generic foundation models from scratch, they focus on parsing massive, fragmented, and disparate data streams to deliver actionable operational clarity at the tactical edge. This heritage means they possess the rare security clearances, past performance records, and deeply entrenched agency relationships that newer tech entrants decades to secure.
This operational reality highlights why the common comparisons between this business and large-cap enterprises fall completely short. When retail investors browse basic financial news on a standard Robinhood stock trading dashboard or look at trend lines on general consumer financial platforms, they frequently try to compare every small-cap player to a massive system integrator or a generalized enterprise provider. But the true competition is fought in the quiet corridors of federal procurement, where compliance, security architecture, and classified past performance matter infinitely more than aggressive marketing campaigns. A specialized trader using the interactive brokers trading tools to track institutional block trades can see that the asset behaves much more like a pure-play defense technology provider, moving in alignment with national security spending priorities rather than general consumer tech metrics. As we look toward the forward-looking horizon, the entire investment thesis for this company hinges on a clear set of future catalysts and structural risks. The primary growth driver over the next 12 to 24 months will be their ability to commercialize their federal expertise into highly regulated civilian sectors, specifically global supply chains, autonomous logistics, and digital identity verification at major transport hubs. If they can successfully port their situational awareness software from military logistics over to commercial maritime ports or global distribution networks, the addressable market expands exponentially. However, the execution risk remains substantial. Navigating commercial sales cycles requires an entirely different corporate skill set than bidding on structural federal requests for proposals, and any delay in commercial adoption will leave the company heavily dependent on the timing of government appropriations. Furthermore, investors must remain highly vigilant about the broader capital market dynamics affecting small-cap tech stocks in the current economic environment. When capital conditions tighten, micro-cap equities naturally face intense scrutiny regarding their liquidity positions and cash burn rates. Investors managing active accounts through specialized platforms like SoFi Invest or active trading accounts must constantly monitor the balance sheet strength to ensure the company can fund its research and development pipeline without diluting shareholders. While larger peers can rely on massive cash reserves to ride out prolonged procurement delays, smaller operators must maintain precise operational discipline. This stark contrast between speculative market expectations and the strict reality of balance sheet execution is exactly what separates long-term winners from temporary momentum plays in this highly volatile sector. Ultimately, the central insight here is that the market is consistently mispricing this asset by treating it as a generic speculative tech stock rather than a deeply entrenched defense technology contractor. The expectation among casual observers is that the stock will only succeed if it mimics the explosive, unconstrained growth of consumer software platforms. The reality, however, is that its true value lies in its structured, cleared backlog and its unique ability to deploy complex data analysis within high-stakes national security environments. As long-term institutional accumulation continues to quietly absorb shares through advanced execution pipelines, the gap between this underlying operational reality and the retail market's superficial perception creates a compelling structural dynamic. Managing an asset like this requires looking past the daily noise of small-cap tickers and focusing entirely on the execution of high-level federal contracts and long-term margin transformation.